In recent years, the global economy has undergone significant shifts, influenced by a combination of sanctions, military actions, and changing logistics. These developments have not only impacted individual countries, but have also caused ripple effects that are reshaping international trade routes and financial systems. To understand these shifts, it's essential to focus on key economic indicators such as export volumes, production capacities, GDP percentages, and energy infrastructure. One of the most notable changes has been the impact of sanctions, particularly those imposed on Russia following its military actions in Ukraine. These sanctions, which include restrictions on energy exports and financial transactions, have led to a dramatic restructuring of global energy markets. The European Union, which previously imported a significant portion of its natural gas and oil from Russia, saw these imports decline from approximately 40% of total consumption in 2021 to less than 10% by 2023. This shift was accompanied by an increase in energy prices in Europe, with natural gas prices rising by as much as 600% in the immediate aftermath of the sanctions. However, while the EU experienced these challenges, other regions and countries have seen an opportunity to capitalize on these changes. For example, countries in the Middle East, such as Saudi Arabia and the UAE, have increased their oil exports to Europe, benefiting from the sanctions on Russian oil. By 2023, Saudi Arabia's oil exports to Europe had increased by 25%, compensating for the loss of Russian supply. Similarly, the United States, once a net importer of oil, saw its oil exports surge, rising by 50% over the past 2 years. These shifts have not only impacted global energy prices, but have also led to a reconfiguration of trade routes, as energy companies look for new markets and supply chains. The global logistics network has also been significantly affected by the ongoing conflict and the sanctions. The war in Ukraine, combined with the pandemic's long-lasting effects, has disrupted traditional trade routes, especially those that rely on Eastern Europe and the Black Sea. Prior to the conflict, Ukraine was a major transit hub for natural gas pipelines and a key exporter of grain. In 2021, Ukraine exported over 44 million tons of grain, accounting for 12% of the global market. With the closure of ports in the Black Sea, the global grain supply chain was severely disrupted, leading to a rise in food prices worldwide. The United Nations Food and Agriculture Organization, FAO, reported that global food prices surged by 30% in 2022, exacerbating the food security crisis in developing countries. At the same time, the war has led to the diversion of cargo shipments and the reassessment of shipping routes. The traditional route through the Black Sea has been replaced by alternative routes through the Mediterranean, which adds significant time and cost to shipments. Shipping companies, particularly those in Asia, have faced increased delays and higher costs, with some shipments experiencing delays of up to 10 days. The Red Sea and the Suez Canal have become even more critical to global trade, with the volume of goods passing through the canal increasing by 12% from 2021 to 2023. This shift has placed additional pressure on the already stretched supply chains and logistics infrastructure in regions such as Africa and Southeast Asia. The economic consequences of these shifts have been felt across multiple industries, from manufacturing to agriculture. In the case of manufacturing, particularly in countries like China, the disruption of supply chains and the rise in raw material costs have led to higher production costs. In 2022, China's manufacturing output growth slowed to just 3.6%, down from 8.1% in 2021, partly due to the disruption of supply chains and energy shortages. The automotive industry, in particular, was heavily affected, with global car production dropping by 4.5 million units in 2022, according to the International Organization of Motor Vehicle Manufacturers, OIK. These challenges were exacerbated by the semiconductor shortage, which also caused a significant decline in the production of electronics. On the other hand, some countries have seen economic growth due to the shifting dynamics of global trade. Countries in Africa, particularly those rich in minerals and energy resources, have benefited from the increased demand for raw materials. In 2022, Africa's exports of oil and minerals increased by 8%, driven by higher demand from China and India. As Western sanctions on Russian exports have disrupted the global supply of certain raw materials, African countries have found new markets for their goods. For example, Nigeria and Angola have increased their oil exports to Asia, while South Africa has seen increased demand for its gold and platinum. The shift in energy production and consumption is not limited to oil and gas. It extends to renewable energy as well. The geopolitical changes have accelerated the transition towards renewable energy sources in Europe and North America. In 2022, renewable energy accounted for 37% of Europe's electricity consumption, up from 30% in 2020. This shift is partly due to the need for energy independence from Russia and the increased investment in green technologies. The European Union has committed to reducing its reliance on fossil fuels by 55% by 2030, with substantial investments in solar, wind, and hydrogen energy projects. As a result, Europe has become one of the fastest-growing markets for renewable energy, with wind energy production alone increasing by 15% in the last 2 years. The changing global economic landscape has also had significant consequences for financial markets. The sanctions on Russia have led to a decline in the value of the ruble, which fell by 40% against the dollar in 2022. At the same time, Russia's central bank reserves have decreased by more than 50% since the beginning of the conflict, forcing the country to turn to alternative financial systems and currencies, such as the Chinese yuan. In response to these shifts, the US dollar has strengthened, while the euro and pound have faced significant pressure. This has led to a reevaluation of currency strategies in countries heavily reliant on energy exports, as they look for ways to diversify their financial systems and reduce exposure to fluctuations in the value of major currencies. Despite the challenges, some multinational companies have managed to thrive amid these disruptions. Energy giants like ExxonMobil and Chevron have reported record profits, capitalizing on higher energy prices. In 2022, ExxonMobil's profits surged to $55 billion, more than double its profits in 2021. Similarly, large logistics firms such as Maersk and UPS have seen increased demand for their services, despite rising operational costs. These companies have benefited from the reorganization of global trade and the demand for new shipping routes, though they are also facing increased competition as new players enter the market. The global shifts in trade routes, energy production, and logistics are also creating long-term implications for global supply chains. As countries reassess their dependencies on certain regions and resources, they are diversifying their trade relationships and looking for new markets. For example, India, which had previously relied on Russia for defense supplies and energy, has turned to the United States and European countries for alternative sources of energy and military equipment. Similarly, countries in Southeast Asia, which had long been reliant on China for manufacturing, are now looking towards India and Vietnam as potential sources of manufacturing growth. In conclusion, the combination of sanctions, military conflicts, and shifting logistics has created a complex and evolving global economic environment. While some countries and companies are facing challenges, others are finding new opportunities in the midst of these changes. The world economy is being reshaped, with new trade routes, energy sources, and manufacturing hubs emerging as key players on the global stage. The long-term effects of these shifts will likely continue to unfold in the coming years, as countries and companies adjust to the new realities of global trade.